And again, remember, all the things that we've gone over, at the end of the day, it flows right into the discount rate. These are political, policy, economic risks reflected in the risk premium, reflected in the discount rate, the volatility in the discount rate, the present values, net present values, and internal rates of return, and make it harder for managers, investment and risk managers to make investment decisions. So let's talk about the yield curve, because the yield curve is probably the most important factor driving capital, both debt and equity. The yield curve, as you remember, is interest rates on the y-axis, maturity on the x-axis, and there are interest rates that are associated with those bonds at that maturity, at that interest rate. Yield curves can move up, they can shift down, they can flatten out, they can invert. They're very dynamic, and they're dynamic over time. The thing you want to understand and you want to remember is that all debt and all equity securities are priced off of the yield curve. All debt and equity securities are priced off of the yield curve. So if I'm issuing a 7-year bond, or if my average holding period for a stock is 7 years, when you're building the discount rate or the cost of debt or the cost of equity, you're going to start with the risk-free rate. You're going to start with the 7-year Treasury yield. If you're pricing debt, you're going to use the 7-year Treasury yield and then start adding on the risk premiums that we talked about before. If you're pricing an equity issue, you'd start with the 7-year T-bill rate, and then you would add the beta times the return on the market minus the risk-free rate, or the market risk premium times the beta, or the market price of risk plus the risk-free rate. So yield curves are extremely important in communicating where we are in the business cycle, but also what the Federal Reserve is doing. And the Federal Reserve controls interest rates on the short end of the yield curve through open market operations. So the Federal Reserve could be buying bonds, driving up bond prices, driving down interest rates. The Federal Reserve could be selling bonds, driving down bond prices, driving up interest rates. They will be buying and selling bonds, driving up and down interest rates to regulate the economy if it looks like it's overheating or if it's moving into a recession. But the thing to remember is all debt, all equity securities are priced off of the yield curve. So you need to watch the yield curve. Inflation expectations. The yield curve is upward sloping. If you use the Fisher equation, it is the real rate plus inflation expectations. So it's upward sloping because of that inflation expectations component, because lenders, people who buy the bonds, want to be compensated for the deteriorating aspects or the destruction of their coupons and their principal due to inflation. They want real purchasing power. So inflation, you have to look at inflation. The Fisher equation is inflation expectations, but inflation is a good indicator of inflation expectations, because if inflation was running high before, you would expect inflation to be higher in the future. So here's the inflation rate, both the consumer price index and the producer price index. The producer price index is the top chart, the consumer price index is the bottom chart. And it shows you that the average producer price looks like it's been around 4% historically. Consumer prices have run around 3%. So the long run inflation rate post-World War II has been 4% at the producer level, 3% at the consumer level. That's your base inflation expectation. But as you can see, it's more volatile on the producer side, which I think is a better reflection of inflation than the consumer side. Although all labor contracts and lease contracts are tied to the local CPI. So the CPI is really the face rate that everybody focuses on. What I think really interesting, other than the average rate of inflation over time, and this is just a basket of goods that is determined by the Federal Bureau of Labor Statistics, so it's a weighted average of prices in a basket. But but the inflation rate really underestimates the true inflation rate. We all have our own inflation rate depending on what we consume. If we have children, we're going to buy more food, which is a higher inflation rate. We're going to consume more healthcare, higher inflation, and we're going to consume more housing, which could be higher too. So each of us has an individual inflation rate, but this is just a gauge of inflation. What I thought was really interesting to see, and this chart goes back to 1980, is that the inflation rate was actually negative. It was disinflationary. And at the end of 2009, in the depths of the recession, it was actually negative. And then the inflation rate actually went up to about 5.5% in 2010. Now the unemployment rate in 2010 was around 12%, very high unemployment, above trend inflation. It's a violation of the Phillips curve. So the question then becomes, why was inflation so high at a time when unemployment rates were so high and we were in a recession? The answer is, it was not a demand pull recession, it was a cost demand pull inflation, it was a cost push inflation. Too much money chasing too few goods because of massive overaccommodation, because interest rates were basically zero. And the Fed flooded the economy with money to drive interest rates to zero, real interest rates negative, to try to get the economy stimulated. It manifested into inflation temporarily in the economy. So if you were in this time period unemployed and subjected to 5% inflation, your real wages were collapsing. And a lot of this inflation too was transmitted overseas to other markets because the money was so cheap here. It moved out of the dollars into other currencies, into other economies, and those countries did not have currency regulation, and they saw massive and hyperinflation during this time period. And the sad consequence of that was the hyperinflation manifested into the Middle East Springs, because one of the reasons why the revolutions occurred was due to hyperinflation that was occurring in those countries because they could not handle the amount of capital flows coming in. Let's look at real interest rates. And remember, real interest rates are nominal interest rates minus the inflation rate. So you're getting negative real return. If you're buying a bond, getting a 1% interest rate and inflation is 3, your real return is -2. You are losing money. You're getting a nominal, but you're losing in real terms. Inflation is eating up your wealth in the process. But this is good for banks because banks basically can borrow at negative real and lend out at nominal interest rates. So it benefits the financial institutions, but hurts the investors. Here is a real yield curve. We've heard of yield curves that use nominal interest rates that are upward sloping. This is the real interest rate. So I went back and I looked at the maturities of the different bonds and then subtracted out the inflation rate to get a real interest rate. And you can spot very quickly who in the spectrum is being hurt the most by very low interest rates. And it is the investors that are investing in 5, 7, and 10-year treasuries. The 5-year treasury bond holders are getting negative real return. Their wealth is actually being destroyed. The 7 and the 10-year fractional return, basically zero. You have to go further out onto the yield curve to the 20 and the 30-year to get some nominal compensation in real terms for investing in U.S. Treasuries. So if you're a pension fund or if you're an endowment and you have to buy long-term treasuries as assets to fund your liabilities in the future, you could be looking at an inability of those assets to generate enough to compensate for the liabilities that are coming due. And my forecast is you will be looking at a pension crisis probably in the next 20 to 30 years because the assets, the bonds, just have not been able to generate enough return to pay off the liabilities that are coming due. Let's look at long-term Treasury yields, the 10-year Treasury yield. Alan Greenspan said if you want to track one interest rate, it's the 10-year Treasury. And the 10-year Treasury is used as the benchmark interest rate to price commercial loans, residential loans, and other types of capital market instruments. And the 10-year is basically the economic and physical life of most physical assets, equipment, plant, human capital. So the 10-year Treasury is very important to take a look at. And you can see it was as high as 16% in the late 70s and early 80s, and has dropped all the way down to, in this case, it's 2.7%, but currently it's running around 2%. So the question is, why have interest rates, particularly the 10-year Treasury, been in a structural decline over the last 20, 30 years? And there has to be an economic reason to it. Some of the reasons could be inflation expectations have dropped significantly over time due to globalization, because as cheaper imports come in, inflation is held in check. Productivity gains by labor, capital labor substitution, adding more technology to your work processes creates more productivity out of your workers, which does not create inflation pressure. That could be another. Let's go back to the 10-year Treasury again. The 10-year Treasury is the benchmark. What I found, you can forecast mortgage interest rates, and you can forecast commercial mortgage interest rates by taking the 10-year Treasury and adding 1.5% or 150 basis points on top of it. So if you see all of a sudden the 10-year Treasury go up 50 basis points or half a percentage point over the last week, it's going to be transferred into the residential mortgage market and the commercial mortgage market maybe 5 days or a week later. So if you have mortgage, if you have a mortgage deal or you're setting up a mortgage for the purchase of a house and you haven't locked it in yet and all of a sudden the 10-year Treasury goes up, you better lock it in right now because you'll be looking at a higher mortgage rate if you don't. So by watching the 10-year, adding the 1.5%, you can track and see where residential mortgage interest rates, 30-year amortized, are going to go in the very short and near future. So you can theoretically predict residential mortgage interest rates. Another thing that I thought was really interesting is I took interest rate 10-year Treasury yields at the growth peak phase of the business cycle, going back in time, and then comparing it to interest rates today to see what the difference was. Because we're in basically the growth phase, late growth phase of the business cycle now. I said, well, where were interest rates 10, 20, 30, 40, 50 years ago at this point in the cycle? And what's the difference? Just to see what it is. Well, the base rate in 2001 was 4.7%. So over 200 basis point less today than it was then. In 1991 was 7.6%, almost 500 basis points less today than it was in the 90s. 80s, 15%, so 1,260. 71, it was 6.1%, 340. So I just calculated it, and on average, 10-year interest rates today are roughly 400 basis points or 4 percentage points less than they were at this point in the cycle 10, 20, 30, 40, 50 years ago. So the question, is why? And I think I went over some of those reasons. And I think one reason too that's not reflected in one of the examples is that the Federal Reserve has pursued an over-accommodative monetary policy consistently since the 1980s. They are more inclined to print money and buy bonds in financial crises or instability. They will print the money, buy the bonds, drive up bond prices, drive down interest rates, but will hold off on raising interest rates until it's too late, and there have been asset price bubbles that have manifested. So it's policy mistakes, consistent, systematic policy mistakes by the Federal Reserve. So let's talk about interest rates again, but let's talk about, the economy right now. What did it grow at in the last quarter? 2.3%, and before that it was like 5%. The long-term potential for the economy to grow, the target rate is 3%. The economy can grow and add jobs and generate inflation at the long-term rate. So if the economy grows at 3%, then inflation will be 3%, and they'll generate enough income to get to full employment. That's the goal. But the economy has not been growing at its long-term potential. Currently it's 2.3, it was 5. Before that, it was at or below the long-term potential of 3%. So why has the economy continued to underperform in a monetary environment that's been over-accommodative? Interest rates are basically zero along the first short end of the curve. Real rates are actually negative. You should have seen more stimulus, more activity within the economy, but we didn't get it. So the question is why? Why did the Fed print so much money, drive down interest rates, and that those low interest rates have not been reflected in higher growth rates in the economy? The answer is in the quantity theory of money equation. By Irving Fisher again, invented the theory of transactions. The quantity theory of money basically states that you have real GDP times the inflation rate equals the velocity of money, which is the number of times the currency, or M1 or M2, circulates in the economy per year, times the money supply growth rate. So real GDP growth times inflation equals velocity times money supply. So let's look at that. We know real GDP has been below 3% for quite some time. The Fed is probably targeting GDP growth rate of 4%. We don't really have a lot of inflation. We still have slack in the labor markets. We have a lot of people who aren't participating in the labor markets. So the Federal Reserve is really targeting a higher real growth rate. And I say they're trying to target 4%. Okay? If you look at the CPI, over the last 4 or 5 years, and maybe even longer, the target rate for inflation by the Fed is 2%. Our inflation rate has been roughly 2%. So we have those two. The money supply over the last 4 years have been growing at about 10% per year, and during the 08, 09, 10 recession, money supply was growing at 30 to 40% per year. Velocity of money, okay? That's really where the secret is. These are already pegged, right? Currently, the velocity of money, I'll show you on the next chart, you can see that the velocity of money is positively correlated with the overall business cycle. The velocity of money peaks during the peak phase of the business cycles and is highly correlated with employment. So as people are employed, they make more money, they spend it and save it, it increases the velocity of money. But in this case, as you can see, velocity, this is using M2, usually is around 2% to 2% at the peaks, right? But as you can see, the velocity of money has broken through its historical support. So actually what we are seeing is a collapse in volatility, right? Velocity. A collapse in velocity of money. So if velocity is declining and if velocity is declining and you've pegged the inflation rate, then to get GDP to grow significantly at around 4%, you need to be printing, your money supply has to be growing at 30%. We know this, that's the target. We know velocity is at 6, on M1. You just plug this number, do the math. The Federal Reserve needs to print money and increase the money supply growth rate to get GDP to grow at 4%. So it's in velocity of money. That's where the answer is. The reason why the economy has not grown above its long-term potential is because the velocity of money has collapsed. And if the velocity of money is collapsing or collapsed, the Federal Reserve can print all the money it wants and buy the bonds and keep bond prices high and interest rates low into the foreseeable future until GDP starts to come back or if velocity goes back up. So the question then becomes, what has caused the decline and the collapse of the velocity of money? And I've come up with a half a dozen reasons. One is the emergence of the global shadow banking system. The Federal Reserve can print money, buy bonds, inject liquidity into the system, inject liquidity into the banking system, inject liquidity into the system, driving down the cost of debt and equity. If I can borrow in the United States at 4 or 5% and invest overseas at 10%, I'm making a 500 basis point profit, interest margin. So it's just arbitrage. And since there's no currency controls, I can borrow here in the United States at very low interest rates and invest anywhere in the world, in any currency, in any stock market, in any bond market to arbitrage. So as the Fed prints money to try to stimulate the economy domestically, the leakage of those dollars shoots out of the system and it has no effect on the system. Velocity is still impudent. Labor productivity participation. Over the decades, plus over the most recent recessionary period, companies have tried to lower their labor costs through automation, a substitution of capital for labor. So having higher productivity rates, lower employment rates, lower income, it has a direct effect on the velocity of money. Capital labor substitution. I talked about productivity through automation, capital labor substitution. Firms are able to borrow very cheaply in the debt and equity markets, even through the banking system, buy equipment, automation, replace workers with technology. Global jobs outsourcing. If jobs are one of the factors that drives velocity, if you're not getting job growth here because you're outsourcing 10 to 20% of your labor to foreign countries, it's not going to transfer through to the velocity of money. Federal over-accommodation. As the Fed continues to print, buy bonds, keep interest rates low, people aren't saving, and they're still probably not investing because they're fearful of the next recession. So Fed over-accommodation, interest rates being really low, impedes the velocity of money. Falling savings rate. People are more comfortable putting their money into cash or some other cash substitute as a precaution for the next downturn. The savings rates are so low, there's really no incentive to stick them in a bank. Might as well just hold cash, especially if you have deflation or disinflation, because you're still getting a return. And the banks can't lend that money out to create velocity in the economy because there's not a lot of money in the banking system. And then rising cash balances. If the Fed is printing money, there's a lot of money in the system, people are working, people are saving, but they have all their money in cash, that cash is not in circulation in the economy. If it's under a mattress or it's stored someplace else, you're not getting the velocity in the money, which will not have an impact on real GDP. So the quantity of theory and money equation is broken down, velocity is broken down, and until velocity comes back, I do not see GDP growth rates being able to run at above 3% for a significant time period, or at least a long enough time period to push down the unemployment rate and increase the labor participation rate. And that's what the Fed is going to have to do. And that's why the Fed, even though they say they're going to stop quantitative easing, they're really not going to stop quantitative easing. They still have facilities that they're using to push up the money supply in the economy, because at the end of the day, they're gonna need to target GDP at 4. Okay, you can, it's not that there.